I was recently asked what makes the home loan interest rates fluctuate and then shared a chart. First, it's my practice to advise consumers to consider the 10-year Treasury bond yield as a barometer or benchmark to track mortgage rates. The 10-year T-bond does not directly correlate to mortgage rates, but it's much more correlated than the Fed funds rate that the media focuses on. The Fed funds rate is a short-term, typically overnight rate, and so is only indirectly correlated to longer-term mortgages. The primary reason the 10-year T-bond yield is a good benchmark for tracking mortgage rates is because most mortgages made in the U.S. serve as a collateral for bonds, commonly known as mortgage-backed securities or MBS. Most MBS are backed by conventional conforming loans owned by Fannie Mae and Freddie Mac. Government loans such as FHA are typically collateral for Ginnie Mae bonds. Ginnie Mae is the term used to refer to the Government National Mortgage Association, which purchases federal insured or guaranteed mortgages such as FHA, VA, and USDA, and then pools these as collateral for Ginnie Mae bonds that are sold in the financial markets. In the chart you provided, it shows that yesterday, the 10-year T-bond yield had dropped by 0.206 to 3.705%. That means the day before the 10-year T-bond yield was higher at about 3.91%. This is a move lower by almost 0.25%. The move in mortgage rates lower tracked the 10-year T-bond move in a similar fashion yesterday. A move in yield of almost 0.25% is pretty large. On most days, the move in yield, up or down, is more modest. In that regard, I often explain that the mortgage rate market is remarkably similar to the stock market, with mortgage pricing meaning rate and points, changing day to day, both up and down, as well as intraday. Because mortgage rates are more closely correlated to the bond market, I always advise customers and prospects that when the Fed announces a change in the Fed funds rate, ignore the news propagated by the media that will oversimplify and lead the public to think the change in Fed funds means a similar change in mortgage rates. In many instances, that's not the case. It's not uncommon to see an increase of, say, 0.50% in the Fed funds rate, where the 10-year T-bond yield actually drops, instead of going up by the same 0.50%. So when the Fed announces a change in the Fed funds rate, it's always best to check the 10-year T-bond yield to get a better idea of what's really going on with the trend in mortgage rates. If you'd like more up-to-the-minute information so you can make decisions based on facts, please call me. I'm Art Alvarez with MortgageWorks, where we have the answers and they're on the house. You may reach me at 760-883-5700 today.